Financial services company Perpetual will be broken up in a $2.18 billion deal, with global private equity giant KKR acquiring Perpetual's corporate trust and wealth management businesses, as well as the famous brand name. If approved by shareholders and regulators, the asset management arm of the company will remain as a standalone business, which will be rebranded. Perpetual's chief executive, Rob Adams, will retire following the completion of the transaction, which is expected to be in February 2025. Well, joining me live is Adam Dawes from Shaw and Partners. Adam, thanks for your time.
Yeah.
Perpetual board says if this deal goes ahead, it offers great value for shareholders, but we just saw the share price on the screen. I think it's the worst day in 18 months for the company.
Yeah.
That tells a different story.
It sure does, and it certainly shows that the market is still looking for a lot of detail that's going in there. I think really the bankers are the ones that are getting rich out of this, but the poor shareholders are probably not doing so well out of this deal so far today.
Yeah, there was an analyst call this morning, and they really want to know more info, because if the deal does go ahead, KKR will get the corporate trust, wealth management businesses and the brand name for about $2.2 billion. That money will then be returned to shareholders after Perpetual pays down debts, separation transaction fees and lots of taxes.
Yes.
This analyst apparently said, is this a joke?
Yeah. Well, I think that's the reason why the stock fell so much, because out of the 216 pages that we had 20 minutes to read before the stock came out of trading halt, there was no real information on tax. There was no information on any of those points that you just pointed out. And that for us means that there's some uncertainty. Now, we know Perpetual would have come out and would have done their due diligence with the tax and those kinds of things. So I think that they would know what's going on, but they haven't told the market. And that's where the issue is, and that's why the share price fell so much today.
Rob Adams, the CEO, joined Perpetual 2018, and he's overseen some big acquisitions at the company. How big's it grown over the past sort of 6 or so years?
Yeah, so it has grown, but really it's all about funds under management. And funds under management have actually been shrinking. The last quarter, they shrunk by sort of $5 billion. Now, remember KKR bid for Perpetual back in 2010, and that was a $38 to $40 bid. Now they're picking it up closer to $21 or $2.1 billion, so $2.2 billion. So, yeah, I think he's done a good job, but it's very hard in this landscape now. And you're always looking for fund managers that are increasing their funds under management versus reducing. And certainly Perpetual has had that negative outflows for a good 6 months, even longer.
There's also another big shareholder here, Washington Soul Pattinson, which is another one of Australia's oldest listed companies, actually.
Yes.
They own about 12% and tried to place a bid last year, $3 billion for all of Perpetual, which was rejected.
Yeah.
How do you think they're going to play this?
I think they're going to be an agitator. They've got, as you say, 12% of the business, so they've got some clout inside of Perpetual. I think they're going to be a bit of an agitator. I think they might even talk about potentially getting rid of the board altogether, getting a new board in there, and then basically trying to hive off some of those assets. That asset business that Perpetual has is a very, very, very good business, as well as the custody business is very, very good as well. The wealth management is okay as well, but it does look like they might be a bit of an agitator and potentially might stop this potential offer going through. So there's lots to play out. And you said February next year?
February 2025 is what it says in the slide deck.
It's so long. It's so long.
Well,
and I think we've got a shareholder vote coming up in August or something like that.
Yeah, around profit results.
Correct. So there's a lot of water to go under the bridge. There's lots of stuff that needs to be looked at. And one of Australia's oldest businesses, it's really a shame to see it leave the ASX.
And the brand name, I think there's a branding licensing deal in place for several years after this goes ahead, but eventually the Perpetual name will be owned by KKR, and the original company, the asset management company that will remain, will have to be something else.
And you're going to have to, a lot of fund managers are going to have to find new jobs. Like there's this whole sort of ecosystem that Perpetual has been in Australia for so long that it's built itself around. So taking that ecosystem out is going to be really, really tough.
And just broadly, looking at the market with asset managers, is it a tough climate right now for them?
It is. It's very tough. I mean, we certainly saw, outflows. GQG is probably the only one that's getting inflows coming in. So that's actually, the share price is actually doing quite well on the back of that. But a lot of fund managers have had to reduce their prices because we've got ETFs now that do a lot of what fund managers used to do. And so investors are doing it themselves and moving through the ETF landscape, which is getting cheaper MERs, management expense ratios, and Perpetual, these guys who would charge 1.5–2% to be in their fund, they've had to reduce their fees. And so it's a very tough business.
So ETFs are really eating their lunch?
Absolutely, 100% it is, yeah.
Well, Adam Dawes from Shaw and Partners. Thanks so much for coming on the show this afternoon.
Great to be here.